Disruption is a common theme in all walks of life right now, and the investment industry is obviously no different to that. To discuss this issue with me, I have Alex Pollak from Loftus Peak. Welcome, Alex.
Thanks, Darren.
Now, disruption. Why do disruptive businesses present a good investment opportunity?
Because they utilise all the available tools, and a lot of the tools are technology. But we're not a technology fund, we're a disruption fund. So the point is that they utilise a whole bunch of the available tools in order to be able to do business better. So the simplest way, or one easy way to think about this is to think about Amazon. Every retailer in the world since the day dot, when they've started a retail business, has opened a shop. First thing, open a shop. Yeah. Amazon has turned the model on its head by using the disruptive tools to be able to say, no, first build a website. If you have a website, you don't need a shop. And because you don't need a shop, you don't spend money on rent. And because you don't spend money on rent, you've got an immediate cost advantage as long as you can load up the website. And that allows you to compete against every other retailer in the world that has a shop.
Right. So then how is investing in disruptive companies different from investing in any sort of other asset class?
It's not different. One of the things that at Loftus Peak, we're all big cap analysts. Yeah. So we have spent all of our investing life on understanding balance sheet, cash flows, P&Ls, from day dot. I've been doing this for more than 20 years, my partner, etc. So it's no different. You need to understand the cash flows. You need to understand the NPVs of businesses. You need to understand per unit economics. It all works the same way as any other kind of investing. Mm-hmm. But there are certain markers along the way which you can also use to be able to understand whether the business that you're investing in is doing well.
Yeah.
So it's everything that is existing and a few other tools as well.
Yeah. So if we look at the effect of disruption in these types of companies like Amazon on the bigger part of the market, what sort of effect are we seeing on the S&P 500 companies right now?
Well, what's happened in the last 15 or 20 years is that the average age of companies in the S&P 500 has declined from 60 years to around about 20 years. And obviously, because companies are dying more rapidly, they're being replaced more rapidly. So what you're seeing is a kind of a renovation, if you like, of the S&P 500, with older companies being thrown out as these newer, fast-growing companies move into the spots previously held. Mm-hmm. I mean, the obvious one, is Kodak, but there's a stack of them. There's the New York Times. There's a whole bunch of companies that have, fallen out of the S&P 500 lists or dropped down them to be replaced by the Amazon and the Googles and the Facebooks, etc. So what you've seen is that the makeup of the S&P 500 has changed very significantly as a result of this, and the speed at which companies grow and die is increasing. And so if you are, as it were, a traditional index manager, you've got some particular problems with this because the index itself is, as it were, backward looking. Mm-hmm. For example, there's not going to be a lot of oil used in electric cars. And so if you're in index energy, which contains a whole lot of oil, then you've got a 5 or a 10-year view which is going to see the basic necessity for oil being reduced.
Yeah. So when you're looking at investing in companies, are there any sort of themes that you focus on?
We've got 5 critical themes, or 5 key themes. Networks is a theme. Connected devices is a theme. The cloud and data is a theme. And energy is a theme. We view energy not so much as a fuel, but as a technology. In other words, energy is not something to be dug up out of the ground and burned. It's something to be harvested, which is all around us, to be harvested and utilised through technology. So very different economics in all of those thematics.
Yeah. Now, is there one sort of common characteristic that you can identify in the companies that you look at?
Well, disruptive companies, there isn't one characteristic. There isn't one characteristic. They are fast growing. Their revenue growth is fast. Their adoption is fast by people. But that in itself, any company can do those things without being disruptive. So not necessarily one characteristic. There are a bunch of different characteristics. Many companies, disruptive companies, do use the network. I guess you could say the one thing that links them all is this focus on using all of the available tools to push out the business model, not just some of them. And I think that's, if I was to say one thing, it would be that.
Okay. Now, obviously, all of this has an effect on value as well.
Well, value investing is your question. Look, it does. We don't really think about businesses in terms of growth or value. We don't buy businesses just because they have multiples of 2 or 3 times, or we don't look at single period comparables like PEs and EV to EBITDAs. We glance at them, we understand them, but we don't focus on them. So we don't not invest in value. But we are very aware that sometimes companies are cheap for a reason. They can be cheap for a reason, and they can be trading on 3 times cash flows or whatever the numbers might be. But there's a reason why they're trading at 3 times cash flow, and it's not that we wouldn't buy them if they had a growth proposition on the end of it. But if they're just trading at 3 times because their fundamental business is falling apart, well, we wouldn't play into that space.
Mm-hmm. Alex, you recently participated in the Undiscovered Managers Showcase, which was presented by Financial Observer and Evergreen Consulting. Can you just give us a little bit of an insight into how Loftus Peak goes about constructing its portfolios?
Yes, we first of all look for companies that fit into the thematics. So the first thing that we do every day isn't actually open up broker research. The first thing we do every day is we try and understand what's happening in business in the world. Mm-hmm. So where there's value being created in business in some area or another, and then we spend a lot of time trying to understand how that value is being created, and then if we see that there's a business model behind it, behind that value creation, then we spend time looking for ways that we can invest in it, and we only invest in listed stuff. We don't do anything in startups or mezzanine. And then we run our own models and our own analysis to sort of work out whether there's value in there. And then finally, we do this kind of understanding where we say, is this actually disruptive, or is it just a fast-growing business? Something can be a fast-growing business, but that's not really the thematic that we're investing in, and that's not where we've sucked out most of the value. Mm-hmm. So once it sort of ticks all those boxes for us, then we look at ways that we can enter it, and then we might even invest in it.
All right, great. Well, thank you very much for your time today.
Thanks, Darren.